Assalamu alaikum viewers, welcome to our channel Practical Study Planet. If you are new to our channel, please subscribe our channel and press bell icon for further updates. Today our lecture is about accounting lecture 1, Introduction to Accounting. In this chapter we will learn about definition of accounting, why accounting is in study, difference between counting and accounting, bookkeeping, main divisions of accounting, basic terms to know for accounting study, major base number of accounts and charts of account, accounting principles, concepts, accounting conventions. Definition of accounting. As per American Institute of Certified Public Accountants Committee on Terminology, accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the result thereof. We make divisions of the definitions in four parts: recording, classifying, summarizing, interpretation. But it must be noticed that all above dealings are in terms of money, aspects calculation. Why accounting is in study? For personal monetary spending, we normally do not need to record all events regularly. It is optional for a person either record or not. But for the business, it is mandatory to record each and every events in terms of money, incoming and outgoing, and finding profit and loss of a business. As the business will be larger, then more proper way records needed to maintain as to be presentable for the government, tax purposes, investors, profit or dividends, or self health of the business. For an individual, it is not necessary, but for the business, it is mandatory. Otherwise, business profit and loss couldn't calculate properly. Difference between counting and accounting. Counting is just calculation irrespective of accountability, whereas accounting is simply counting plus accountability, means that ask all questions of why, when, where, who, whose, whom, how, etc. Bookkeeping. In old era, it is referred to have different books of accounts to record the business transactions in proper manner, whereas in modern era, it might be mostly in accounting business software where all records are compiled and posted in defined specific way. As shown in the figure, the manual books of records is there, and in software also the automatically all transaction will be posted to the next stage. In divisions of accounting, based on wide area of study of accounting, it has been divided into three divisions to explore separately. Financial accounting, profit and loss finding at particular set period range. It tells the financial position of the business. So the second one, the cost counting, it is basically the deep study of cost of goods manufactured in either to avoid loss or wastage during production and controlling the cost at the optimum level. The third one, managerial accounting, from both above both accounting bases, collected information to be used for making business decisions. In this part of accounting, by applying different defined sciences such as ratio analysis, etc. Basic terms to know for accounting study. Event. Any happening or occurrence anywhere is called event. In business transaction, if event is of monetary nature, then it is called the business transaction. Capital or owner's equity, the total wealth specified by an individual for business. It might be cash, building, etc. Assets, all the valuable things owned by business for business operation, that is called assets. Goods or inventory or stock or merchandise, materials for resale purposes in business to generate income, that is called inventory or goods. Purchases or purchase return, the process of buying goods for business is purchases, and to return back due to any reason is purchase returns. Same way, the sales or sales return, the process of handing over goods to anyone for money is sales, and to return back due to any reason is sales return. Debtors accounts receivable, to whom goods or services sold for money to get in future, that is called credit sales, or the process of selling is called the credit sales. And the debtors, the person who will pay later, that is the debtors. Creditors account payable, to whom good or services bought for money to pay in future, that is called the creditors. But the process of purchase, it the credit purchase. Expenses, spend expire assets or of the company for getting benefit for businesses. Revenue, income or benefit earned for company. Liability, the total wealth or value in company of others to whom business is liable to pay, that is called the liabilities. Now the major base number of accounts and charts of accounts. Total major base accounts are 5. The one asset, second expense, third revenue, fourth liabilities, and fifth capital. Chart of account. All accounting records are maintained under an account, and all accounts are by nature under above mentioned major accounts. For example, vehicle, cash, goods, building, debtors, all are assets accounts. Petrol, salary, electricity bill, depreciation are accounts or expenses account. Sales, rent earned, discount received, extra accounts are revenue accounts. Creditors, bills payable, salary payable, extra accounts are liabilities account. Invested new amount in business via any partner accounts, that is are capital accounts. Accounting principles or concepts. There are 8 concepts of accounting which are mandatory to follow for accurate accounting practices. Separate legal entity concept. Business is separate and owner is separate. Always will be treated accordingly. The second one, going concern concept. To practice accounting with the view that business will never shut down and will continue till indefinite period, except it is closed by owner intentionally due to any reason. The third one, money measurement concept. Only record monetary transactions of business, not any non-monetary events such as one party held at Paris, that will not be recorded. Just the expenses or the money incoming and outgoing will be recorded. The cost concepts, it's mean all assets value will be measured as per current value of the market. If book value of an asset is higher than market value, then it will be revised according to the market value of that assets. Cost is also reduced by following depreciation method. The fifth one, dual aspect concept. There is always two aspects while in one accounting transaction and will be recorded accordingly. For example, Mr. Ali invested cash 5,000 in business. There will be two effects in business simultaneously. One, cash in business as a current assets, and same time the capital in the business will be same valuation 5,000 in business. According accounting period concept. The sixth one, accounting period concepts. According to this concept, we fix one period for closing the accounts to measure the business profitability and financial position of the business. The seventh, the matching concept. Revenues and expenses will be recorded as per their incur time period. For example, we paid rent for building in advance for 1 month, but yet not occupied building, then we cannot record now as expense, but we will record as prepaid expense. When we'll use the benefit of building against rent paid for 1 month, so that at the last 30th day we will record the expense. The eighth concept, realizations concept. Same way, if we have received payment in advance but yet not goods or services rendered, then we will just record amount as liability. Only when rendered services deliver goods, that time we can record as a revenue earned in business. The ninth point, accounting conventions. There are four accounting conventions which are optionally followed for beauty of the accounting. Conservatism, anticipate no profit but provide for all possible losses. The second one, full disclosure. All accounting records must be in details, either needs, notes, or explanation must mention for all stakeholders of the business. The third, consistency. If one particular method adopted for accounting practice, always follow the same, not change without any reason to fix it. The fourth, materiality. This conventions allows accountant to stick with major things to avoid major variations on financial statement, can ignore minor things in business such as wastage of pencils, sharpeners, waste baskets, etc. Thanks for watching the video. Please like, share, comment and be connected with us for such informative videos.